He said, I'm the CEO and co-founder of Innovance, and really our mission is to help traders like yourself develop robust strategies. The best way we've found to do that is by leveraging machine learning and artificial intelligence. There's a couple reasons why I'm really excited about these techniques, especially when it comes to algo trading. First, they've been proven successful. So the largest quantitative hedge funds like 2 Sigma, Renaissance, and D.E. Shaw all apply these techniques and have shown that over a long period of time that they are able to generate significant returns. The second is that a lot of these techniques and a lot of these tools are just now becoming accessible. So even a couple years ago, if you wanted to use these machine learning algorithms, you would have to develop it by hand, need a lot of really strong math and computer science background, and develop a lot of time and energy in building the infrastructure. But now there are so many different open source libraries and tools out there that without needing to know how to do it yourself, you can get a great start and really apply them and leverage your own experiences in technology. And finally, these machine learning and artificial intelligence, we're riding a much broader trend across a lot of different industries. I'm sure people are familiar most recently with AlphaGo beating the new, the best Go player in the world with their deep learning and all of their artificial intelligence. We see that in the self-driving cars and drones, and everything that you learn and all the different techniques that you apply to your own trading are actually applicable in a lot of different verticals. And if you can prove yourself in the financial space, then that's really one of the hardest applications of AI machine learning. And if you do want to switch industries or focus on other different types of problems, a lot of these skills are very applicable in different verticals. So before we get started, just to go a quick overview of what we'll cover today. And I'll share this presentation with everybody after, so don't feel like you need to take a lot of notes, and there will be a lot of links in here that you can use to get more information on the topics that we cover. So just give you where the perfect audience for this is someone who's familiar with algo trading but doesn't necessarily know a lot of artificial intelligence and machine learning. And what we want to focus on today is how you can apply these techniques to your own trading to actually improve your results and improve your returns. So first, we're going to go over some terminology to make sure we're all on the same page. Second, I want to cover the best practices and common pitfalls that I see a lot of traders and a lot of quants falling into when they're first getting started. Then we'll dive into some very specific applications on how you can use these techniques in your own trading. And then finally, we'll do a very quick run through of building our own algorithmic trading strategy using pattern recognition and association rule learning, and you'll actually come away with a strategy that you can trade live at the end of this presentation. So as we go through this, feel free to jump in with any questions, whether in the questions menu or in the chat, and we'll also leave time at the end, so if you have any more broad questions about anything that we covered, feel free to save them to the end or ping me as we go through this. So as long as everyone can hear me okay and there's no questions to get started, then let's go. All right, so first to cover some basic terminology. I think this is important because you hear a lot of these buzzwords get thrown around. So we had one question: what kind of technical background does an individual need? I would say if you have any sort of basic programming background or even understand the concepts of algo trading, you'll find this valuable. And even if it's something that you're just getting started with, this will be a way that you can really get a jump start in your own education in order to ace in this field. So I'll cover that question towards the end. Okay, so getting back to the terminology. So first is artificial intelligence. So I like to define that. So how do I view the chat window? You should see in the sidebar to the right, I'm not exactly sure what it looks like on your screen. If you want to message the moderators with any questions on logistics or the organizers, they'll be sure to help you. So getting to the terminology, first, artificial intelligence. Artificial intelligence, I like to define it as a study of intelligent agents. So an intelligent agent is a system that perceives its environment and takes action to maximize its chance of success. So there are two parts to this definition that I want to really focus on. So first is something that perceives its environment. So this means that there's some sort of data coming in. Now this data can be anything from something that in the trading world we like to think of indicators. It can be images if you're a self-driving car, or maybe it's where the pieces are on a chessboard. But all that's really important is that there's data feeding into the system. And second, it takes action to maximize its chance of success. And what this means is that it needs to know what success looks like. It has to have some criteria that it's trying to fulfill, trying to optimize for. So whether this is not getting into a car accident, whether this is maximizing your returns, or winning at Go, these agents know what they're trying to achieve. Next, we have machine learning. Machine learning is a subset of artificial intelligence, but it focuses specifically on the algorithms that can learn and make predictions without being explicitly programmed. So the difference between a machine learning algorithm and any other type of algorithm is, let's look at a simple technical analysis trading strategy such as a moving average cross. So if you're just developing your own quant strategy, you would sit there and you would program in, if the 10-period moving average crosses more than 5 pips above the 50-period moving average, then I want to buy. When we're looking at machine learning, these algorithms would not only potentially be able to tell you what periods of these moving averages you should look for, but really what the entry signals need to actually be. And what you're feeding them is just the raw data, and then they're making these predictions and finding those patterns on their own. So we had a question, what are the criteria on that traders have? So there's a lot of different criteria that a trader can have. It could be absolute returns. It could be risk-adjusted returns. Maybe they're interested in diversifying their strategy compared to their existing portfolio. And that's really going to be up to the individual trader. So moving along, we have pattern recognition. So this one speaks for itself a little bit. It's the branch of machine learning that's focused on uncovering patterns in data. I wanted to make this its own definition just because machine learning can be used to solve a lot of different problems, and really what we're going to be talking about today is specifically pattern recognition. Then association rule learning, which is a lot of what we do at Innovance, is basically formatting these patterns in the format of if-then statements. So there are a lot of different algorithms that do this for you, but really what I like a lot about association rule learning is that it's a very tangible, useful, actionable output. It's not something that's very a little bit more abstract, like a correlation coefficient, but it's just if this, then that. Really the textbook example of association rule learning is they do it in supermarket layout, where they say, all right, if you're buying milk and cheese, you're probably going to want to buy butter as well. So if these two conditions are met, then place the butter close by. Finally, we have big data. This isn't something we're going to be talking a lot about today, but I wanted to include it just because it gets thrown around a lot, and I think there's a lot of misconceptions on what big data is. So what I look at big data is, and what's becoming a little bit more commonly accepted, is that it must follow the 4 V's. First, we have volume. So there's a huge amount of data, usually on the scale of terabytes. Second, we have velocity, meaning this huge amount of data is coming at you fast. Third, we have variety. So this data comes in a lot of different formats, whether it's numerical, categorical, images. It doesn't necessarily need to contain all of those, but usually it contains a variety of different data formats. And finally, veracity, meaning that you're not 100% sure that all the data coming in is correct, is true, and that there might be some data that's inherently false. So those are a couple terms that we'll be going over today. Here's a little image that can give you a more tangible grasp on where these fit in. So we can see computer science, all of these fall into the realm of computer science. Subset of computer science, we have artificial intelligence. One of the subsets of artificial intelligence is machine learning, and within that we have the pattern recognition and association rule learning. And then we can see overlap with data mining, which is never a very common term. One of the reasons why it's not entirely within artificial intelligence is data mining is more broad in the sense it's just extracting useful information from data. Knowledge discovery is another term for this. So it can overlap with artificial intelligence, but isn't necessarily the same thing. This presentation will be shared at the end, so you'll be able to get all these slides yourself. Okay, so now I'd like to go over some best practices and common pitfalls that I see a lot of traders and new quants getting into. And if there is one takeaway and one thing to remember from this presentation, it's really this slide, because I think this is the blueprint for what makes a successful quant and a successful trader. So first, you have to define success. If you don't know what you're trying to achieve, where you're trying to go, there's no way that you're going to get there. And it's easy to say, oh, I want to maximize returns, or oh, I want to build a profitable trading strategy, but you really need to attach some tangible, achievable, objective goals to that. You know, if you just say, I want to be profitable, well, if you have a strategy that returns 0.5% over 10 years, yeah, that's profitable, but that's not really what you're looking for. So at least defining that maybe it's risk-adjusted returns, maybe you're looking for a portfolio of uncorrelated strategies, something along that. You really need to know where you're going in order to get there. Second is simplicity. It's really easy to get caught up in using the latest artificial intelligence or machine learning algorithm to achieve these goals. But before you dive down that rabbit hole, you really need to make sure that that's the best tool for a job. You know, for example, let's say that you wanted to figure out when the market was in highly volatile conditions. Well, you could spend a huge amount of time building something like a hidden Markov model, which would classify the market in different regimes and run in a completely automated fashion, and you could spend all this time and energy building it and testing it. But at the same time, you could have just used a simple filter on the average true range and get about 80% of the same results. So it's up to you to decide whether that last 20% is really worth the huge amount of effort and time that you put in, as well as the risk in building a much more complex system. So before you start using these more sophisticated techniques, just ask yourself, is there an easier, more simple way that I can get the same solution? Third, you really need to focus on the process. And this is what I think sets apart the top hedge funds and quants in the world. It's not necessarily that they have the best infrastructure or all these unique data sets. While those absolutely help, the reason why they've been successful over such a long time frame is because they focus on the process. They know where their assumptions and where the uncertainties are, and they're not really focused on building a singular model. What they're focused on is building a very robust process and building a very robust workflow that's going to continually keep churning out models and signals and analysis that they can trust and they can stand behind. You know, every model is eventually going to fall out of sync with the market. So what you need to know and what you need to have is a whole process to come up with the next model, the next strategy that's going to continue to work. And fourth, every single step of the way, you need to have a very healthy dose of skepticism. Naturally, as humans, we tend to be much more biased to positive results. You know, for example, if you run a back test or you run a strategy and the results are terrible, you're probably going to sit there and go, oh crap, what went wrong? On the other side, if something tends to go well, you're going to sit there and go, wow, that's great. I can't believe that that was produced so well. I can't believe the results were so great. Let me just move on. I can't wait to start trading this live. So what you need to remember is that, okay, these results are almost suspiciously good. Let's make sure that they are actually correct. All right, so now diving into the actual applications of these techniques. So the first question that a lot of traders and quants ask themselves is, how do I know which indicators to use to build my strategy? There's this huge universe of data, whether you're interested in fundamental analysis, technical analysis, sentimental analysis, maybe you have your own unique proprietary data set, but figuring out which indicators and which data sets to trade is an incredibly difficult problem. You have this huge universe, and knowing which ones to choose is a hard, time-consuming process. Luckily, this is an area where machine learning can really help out. So first, we have decision trees. So decision trees are a machine learning algorithm that split the data set using recursive partitioning. So what this means is that they'll search the data set and find indicators and indicator values that best split the data. Now, this definition of best can be can be quantified a lot of different ways, but most algorithms use a metric of homogeneity, which basically means where can I split the data to have the two most distinct or separate groups. And you have this concept or this metric of purity for each group. Now, the way that we can use this in indicator selection is that indicators that appear towards the top of the tree tend to be able, or are by definition, able to split the data sets into two more pure groups. So what this tells you, this gives you some more information, and these are more important indicators and have a higher relationship to the data set that you're using than indicators that fall lower down on the tree. Now, you can see in the example that this is obviously an overly simplistic example, but these are the type of results that you're going to get if you use a decision tree with a large collection of indicators. You'll notice that they also give you entry and exit signals, but with something as basic as a decision tree, I wouldn't suggest using it on its own. Now, a random forest is a much more robust and much more powerful way to use decision trees. So how a random forest works is instead of using one decision tree, you build thousands of decision trees on slightly different variations of the data set, and then using cross-validation techniques, you're able to test it on new data. So what this tells you is, all right, looking at the entire data set, incorporating some out-of-sample analysis, you can see which indicators consistently end up at the top of the tree. Random forests are a very powerful algorithm for a lot of different applications, and they're actually something that you could use if you are interested in generating entry signals using machine learning algorithm on your own. We'll cover a little bit more of that later, but they're also a very robust, really great way to use them to select indicators. You'll see that decision trees and random forests are both hyperlinked. The links will lead you to some articles and some blogs that we've done that really step you through how to use these yourself. If you're looking, we had a question, which approach would provide better results? It's random forest 100%. So random forest is just 1,000 different decision trees. It's much more robust. The downside is it's more complex. It's not going to be as transparent to how it works. You're not going to be able to visualize it since you're going to have thousands of trees. But if you're just interested in, all right, between these three indicators, which one should I use? A random forest is definitely the way you want to go. Is indicator selection the same as feature selection in machine learning? It absolutely is. So for this presentation, we'll be using features and indicators almost interchangeably. You'll see a little bit later, a little bit farther on, that you can build features off of indicators, but for this first part, we can use indicators and features interchangeably. Good to see we have some people that have a little experience in machine learning here. All right, so moving on to the next slide. Now, what if we're not interested in just individual indicators? What if we're interested in indicator sets? So, for example, let's say we want to, an RSI on its own isn't that great, and the MACD isn't that great, but combined that they can be a very powerful combination, and they really complement each other well. There's a technique known as a wrapper. Another question. These indicators will have lag. What's the point in using? So that's really more of a question on whether you believe in technical analysis in general. I think that indicators do have inherent value. So while they lag, they also have the benefit of showing you a little bit more of the underlying patterns, the underlying trends that isn't going to get whipsawed by pure price action. You can use a lot of these same techniques by using candlestick patterns, support and resistance, whatever you want. I'm just using technical indicators as an example because it's easy to understand. But really, you can feed in whatever data set you want into these techniques, and you'll get, the underlying principles still remain the same. Okay, so getting back to wrappers. So what wrappers are doing is that they're showing you the best indicators combinations to use. So we had another question. Can we decide indicator parameters based on machine learning or optimize indicator parameters to check most suitable for any suitable one for any data set? So there are absolutely ways you can do that. It's going to require a little bit more work on your end. So one way to do that is by when you have this evaluation criteria or this evaluation set, you would run that evaluation set over a variety of different data sets, or come up with a more automated way where you can run these techniques over a variety of different data. If you're interested in discussing a little bit more specifics of that, I'm happy to dive in, so you can reach out to me after the presentation. So I'm going to, just to keep this moving, I'm going to try to keep the questions to a little bit minimum, but definitely keep typing them, and then we'll get to them at some point. So what a wrapper does is you have your indicator set. So you have RSI values from 0 to 100, or RSI values, MACD values, and support and resistance lines, maybe Fibonacci retracements. You're going to select a random subset of those indicators, use a machine learning algorithm or a classifier to analyze them, and then evaluate the performance on an out-of-sample data set. So what this allows you to do is find the relationships or find the best collection of indicators instead of just looking at indicators individually. So anyone who's traded before knows that it's important, or that you can get a lot of information by combining multiple uncorrelated indicators and not just looking at individual ones. So let's keep moving. So I'll answer your question at the end, Mukul, just to keep us moving. So the next way that we're going to be looking at indicators, another way that you can help select indicators, is let's say that you have your own proprietary data set, or maybe you have your own theory or a thesis about the market, meaning that you kind of know which collection of data you want to use, and you're just looking for the best way to use it. So one of the most powerful techniques from machine learning is known as ensemble learning. So in this case, what that means is we're combining multiple uncorrelated classifiers to generate a more robust signal. And the advantage of using this technique over something like a wrapper or a random forest is that we can use a lot of different classifiers. So for instance, we can combine a machine, we can combine a support vector machine with a neural network, with a random forest, and have all these different classifiers analyze our data to find different patterns and information within them. James, if you have some questions about the webinar is, I would suggest contacting the moderators. Okay, so let's move on to the second part, which is once we have these indicators, so feature selection is different from feature extraction. So we didn't cover feature extraction too much in this presentation, just because that's a different topic. So feature extraction, just for people that knowing, is maybe you want to combine 3 different indicators, or you want to find the best way to look at this different data. But right now for this presentation, we'll just assume that you're keeping the indicators constant, or you have a data set that you're using and working with, and you're not interested or not as concerned with the feature extraction. Yep, so using too many multiple classifiers, aren't we doing curve fitting? That's absolutely right. So curve fitting is an incredibly important area, something that you always want to be conscious of as you're going through these processes. So if we go back, you always want to be testing out of sample. You always want to be making sure that your classifiers and the algorithms that you're using aren't overtuned. We'll get into a little bit more about how to prevent overfitting later in the presentation, but that's definitely a good point, something to be conscious of. So moving on to association rule learning and pattern recognition. Really quick, just to go over their definitions one more time. So pattern recognition is just machine learning that's looking on patterns or regularities in data. Now what association rule learning is a sort of pattern recognition, except we're formatting these patterns in if-then statements. So there's a couple different reasons why we wanted to combine these two and why in advance we spend a lot of time looking at pattern recognition and association rule learning. Is that we see this as a very powerful way to leverage machine learning algorithms while still being able to interpret the output and apply it to our own trading. Getting back to a lot of other questions, a lot of other applications, and even back to one of our 4 main points, is that we want to keep it simple while still being sure that we're leveraging the capabilities and powers of these processes. So to give you a quick example of how we can use pattern recognition and association rule learning together to build a strategy, here's an actual study that we did ourselves. Sorry, going backwards here. So here on the left, we used a support vector machine to analyze a 3-period RSI as well as the difference in price, difference in pips between the open price and a 50-period SMA on the Aussie USD 4-hour charts. So on the y-axis here, we can see the RSI values. On the x-axis, we see the difference in pips, or tenths of a pip, between the open price and the SMA 50. And then what we did is that we used a support vector machine to analyze these 2 indicators and whether they have a stronger relationship or whether they predicted a price increase or a price decrease based on those two inputs. And what was really interesting is you can immediately see some very clear patterns emerge. We can see that when the RSI was between 50 and 75 and the price was between 0 and 20 pips above the 50-period SMA, that was a good time to go long. And when the RSI was less than 25 and the price was between 10 and 5 pips below the SMA, that was a good time to go short. So by combining pattern recognition and association rule learning, we were able to use a machine learning algorithm to analyze this huge amount of data and then translate that analysis into trading rules or something that we can actually put to our own strategy. Now, there are a couple obvious advantages to doing something like this. So like I said, you can leverage the machine learning algorithms. The final output is very transparent, meaning your rules are written out in plain English, and it's very easy to manually implement those rules. You also have the advantage of using your own intuition or experience when analyzing the output. However, there are some very important disadvantages. Obviously, if we go back to this looks all well and good when you only have 2 indicators, but what if you have 3, 4, 5, 6 different indicators you want to analyze that you're looking at? Analyzing data in that high dimensionality space is really difficult. Second, it's not inherently easy to automate. So yeah, we have these rules, but how are we actually going to implement them? And then finally, the human factor can kind of work both ways. So while you're able to use your own analysis and dive into it, some of your own biases may creep in and override the results, or you may just see the patterns that you want to see. And finally, it's also hard to interpret that output. So just because the support vector machine predicted to go short during these RSI values and when these conditions are met, how do you know that's actually a good strategy? How confident was the algorithm? What kind of returns am I going to get had I followed that? Now, these are all questions and all concerns that we wanted to address in TRAIDE. We wanted a way for traders like you to be able to leverage these algorithms to analyze whatever indicators you want to look at, and then be able to dive into those patterns to actually build a strategy. So make something that's a lot more flexible and a lot more powerful when you're looking at your own trading. So very quickly here, we'll just go through a quick example of how we would build these live strategies ourselves. So this is the TRAIDE platform that we've developed. It's all completely free to use and all cloud-based. And at the end of the presentation, we'll share the link with the strategy so you can actually go and trade yourself. Once we log in, we can see some strategies that come pre-created, but let's build a new one. So going through this, let's say that we wanted to trade the Aussie USD on daily charts, and we want to analyze the last 5 years of data. So getting back to the point on overfitting, something that we really want to be careful of and always be sure whenever we do any sort of backtest or analysis is to leave enough room for out-of-sample testing. So what we're going to do here is only train our algorithm or only analyze our strategy up until January 1st, 2015. So what this does is this gives us a year of out-of-sample data once we build our strategy to test it on data that it hasn't seen before. I can't iterate enough how important this step is, and you always have to be careful not to burn or waste this out-of-sample data because once you run multiple tests over it, then it effectively becomes your in-sample data and is not going to, you're just biased towards selecting a algorithm or backtest that does particularly well over that data set. And that, just to reiterate, that is what curve fitting is. So instead of finding the underlying signals or the underlying patterns in your data, what you're doing is just memorizing the little random and little random permutations in that particular data set that aren't going to hold up when you move to live data. So let's give this a name. We'll give this a webinar strat 1. And then we'll select the indicators that we want to use for your entry and exit signals. So we covered a lot about indicator selection already today, but what we like to do in TRAIDE is make it really easy to test different combinations of indicators. And just to save you guys some time on your end, I've already gone through this process and selected some indicators that both made sense to me, as well as I was able to find strong signals in using these machine learning algorithms. And one of the advantages of using a tool like this is that you don't have to start from scratch every single time. What I found as a particularly successful methodology is varying the time periods. So what we can do is we can look at where the open price is compared to a 50-period simple moving average. What this is going to do, like we saw before, is going to give you a sense of what the overall larger trend is. Then looking at where the price is relative to the min-max range over the last 7 days is going to give me a sense of what the most recent trading range is. So is the price towards the, closer to the high over the last 7 days or closer to the 7-day low? That's going to give you a lot of information on where the current price is and where it could be moving. And then finally, we're going to look at the rate of change over the last 3 days, which is going to give you a sense of the short-term momentum. So once again, these are 3 indicators that I've tested, that I've looked through a lot on my own, did my own analysis on. They have the advantage of they make sense to me. I've used them before, and I think they do a good job working together to build a strategy. So with TRAIDE, or usually when you build a strategy, you'd have this chart up and you'd bring up these 3 indicators and you would sit there and try to figure out, okay, it looks like when the price is above the 50-period moving average and the current price is, in the upper half of the 7-day range and it's been on an uptrend, I think that's a good time to buy. So audio seems to have cut out. Is anyone else having trouble hearing me? I'm going to keep going unless I do hear a lot of complaints, so hopefully the rest of you guys can hear me. But just to get back to it, what we're doing, instead of us sitting there and trying to analyze thousands of data points over 3 indicators, we're going to use machine learning algorithms to do the analysis for us. And what that means is that they're going to find the relationship between these indicators and the price movement of the Aussie USD on daily charts over this 5-year range. So we'll click Analyze, and we'll see what patterns we were able to uncover. So once the analysis is finished loading, give it 1 second here. It runs a little bit slower since I am sharing my screen, but usually this will go right along. We can see the indicator plotted out on the right here. So here's the min-max range is normalized between 0 and 100, and we can see whether each resultant bar closed up or down. So for this particular point, when the price was, looks like about in the 56th percentile, the resultant bar closed up. But what's really interesting is on the left here, we can see a histogram of all those points combined. So meaning when the current price was between 5 and 15, by the way, we saw that there was, back here, 93 bars that closed up and 97 bars that closed down, but TRAIDE's algorithms were able to find a strong long signal denoted by the darker color. So what we're going to do is then build our strategy by selecting indicator ranges where TRAIDE's algorithms were able to find strong signals. And just like that, we can see the results. We can see those rules written out. So we see here that I decided to go long whenever the min-max ratio was between -5 and 15. Here are my rules written out. Then you can see the equity curve here plotted out. Now what's really interesting and where the power of TRAIDE comes in is what we're really interested in is the relationship between the indicators. So if you notice, if I unselect this range over here, that the patterns in my ROC change. So what this is now showing me is when the min-max ratio was between -5 and -15, what patterns emerged in the ROC3. And pretty clearly we can see a very strong signal when the ROC was between -1.8 and -5.9. So then we're going to add that as another condition to our long rule. And just like that, we can start to see a pretty good strategy form here. If we want to go look at some more stats, we can see that we're 58% accurate. Our return per trade was $8. So how does the R data for working on R or WECA look like? So all we're using, sorry, I should have reiterated this in the beginning. So we're using raw price action data, so the open, high, low, close on the Aussie 4-hour charts. And then we're using the indicator library, an open source indicator library, TRAIDE. And then if you want to go more on the machine learning algorithms, you can check the machine learning tab here, and you can see that we're using a Ripper rule learner. So if you like to, you can reproduce all these results exactly like you say them if you want to do it manually. But what we do is just make the process a lot easier. Are they available in R and WECA too? They absolutely are. If you go to our website, you can download the data. You can find a link to the open source indicator library, and you can get more information on the Ripper rule learner. So if you want to do this all manually by yourself, you're absolutely able to. What we're trying to do is make it as libraries for indicators is TRAIDE. And if anyone has any questions, we'll include that in the link at the end of it. Got more questions here. So if you want to use a different machine learning algorithm, that's capabilities that we're going to be building into the system. So stay tuned for there. We found that the Ripper rule learner is a really good algorithm for testing over a variety of different data, but it works well. So getting back to our strategy, you can see that we have conditions or rules for the min-max as well as the ROC. If you do have a question, you can feel free to type it into the box. And then finally, we're going to add a rule for where the price is relative to a 50-period SMA. So we can see 2 different ranges here where TRAIDE's algorithms are able to find strong signals. So we're going to continue to refine our rules. And once again, the advantage of TRAIDE and really why it becomes a powerful tool is that you're able to use the analysis of the results of the Ripper rule learner to find where it was able to find the strongest signals to go long. You can build the rules directly off the histogram chart so you can see exactly what your rules are saying. And you're also able to find the relationships between your indicators. So meaning we're not just looking at the ROC on its own, we're not just looking at where the price is relative to a 50-period SMA, we're looking at the relationship to them. So when the ROC is in this range, what patterns emerge in the price compared to the 50-period SMA. So you can use whatever combination of indicators makes sense to you, and then to really dive into the patterns and relationships between them. Can custom indicators be included in the strategy? So that's another capability that we're working on very, very hard. I'm happy to talk more about those, and we'd actually love to get your input on the format of the custom indicators. So meaning, you know, do you use MetaTrader? Are they written in Python? What type of indicators would you like to include? So if you want to message me after, I would really appreciate that, and we'd love to work with you on how we can do that for you. So in terms of ensembles, that's something that we can talk about later. Okay, so just to continue with this, since we don't want to go too far over time, I'm going to build the short rules to our strategy following that same procedure of looking where trade signals are able to find a strong short signal. We're going to go short whenever those conditions are met. And then we're going to continue to refine our rules as we go down through our indicators. Now, just to be clear, just since in the interest of keeping this webinar to the shortest time, and that we have enough time for questions at the end, usually I would spend a lot of time really testing out, really diving down into these patterns. But since this is a strategy that I have built before, beforehand, I can just kind of select the rules that I know are going to look good, but you can see how it'd be really easy for you to cycle through these and explore to see which indicator combinations work the best. Oops. All right, so remove this one. That doesn't look like a very good strategy at all, does it? So now that we have our rules written out, so we can see, like I said, we can see the rules here in the table. If we're interested in the individual trades, we can see all the trades and the entry and exit times. Oh, sorry, it seems like we got a lot of. So we're not focused on high frequency indicators without basic knowledge. So this allows you to really test on this. So if anyone has any specific questions on their applications, feel free to message me after. But we did have one question on how you can apply this to your own trading, and that's a great question and something that we're able to do. And what you can do now, let's say you've built your rules, you've selected the indicators that made sense to you, you're able to dive down into the patterns. What I can then do is generate the code for a fully automated strategy, or what's known as an expert advisor for MetaTrader 4. So if we go down here, we can see the code, the open source code clearly written out, or not clearly written out, but it is open source, so you can change and modify as you like. So we're going to copy this and then move over to our MetaTrader 4 terminal. So what we're doing here is we're now taking the results of our strategy, and now we're going to be testing it out of sample in MetaTrader 4. So what that means is that we're going to be looking at data that wasn't used to build the strategy to see how it did over that last year of most recent data. Now, once again, I really want to reiterate that this out of sample step is incredibly important. So just copy and paste that code. Yes, so they are, sorry, I should have, for the transaction cost question, if you go to the stats tab, you can input the transaction costs yourself. So here we're assuming a 1 pip spread. If we'd like to change that to 2, that's something that we're able to do. So they are incorporating transaction costs. So is this algorithmic trading? It absolutely is. All right, so getting back to the actual sample and testing. So we've loaded up our EA code of our strategy into MetaTrader. And now what we're going to want to do is test it on the most recent data. So what this is telling us, oops, gotta make sure it's compiled and saved here. All right, should be there. I have the little window in the way here. So we have our webinar strategy. It was an Aussie USD strategy, so we're going to select that. And then we're going to look at the most recent data, so the year of data that was not used to build the strategy, and see how well it performs. So if you wanted to do AFL or different format types, you can look at the raw code and recreate it, or we're going to be supporting exporting in different formats very shortly. Currently, we've been focused more on MT4. Different position sizing is something that you can implement on your own. So once we get to the expert properties here, you can see that the inputs allows you to change the position size as well as set a trailing stop. But if you wanted to have any experience with coding, since it is all open source, you can implement your own position sizing techniques. So getting back to this, let's run our simulation, and once again, we're testing to see how well that strategy we built performs over out-of-sample data. So bear with me now as we run just a very quick simulation. Shouldn't take too long at all. Oh, oops, actually we want to set this to make sure that we're on the right time frame since that was a daily strategy. And then run this. So if anyone has any questions in the meantime, I'm happy to answer them as they run. So we had a question about incorporating the predictive algorithms. So if we go back to the application, the signal strength here, the color of the bar is how the algorithms are being incorporated. We got some good results. So let's go back and we'll watch our simulation run here, which is always fun. So if people aren't familiar, this is a MetaTrader 4 trading platform, very popular in the FX space. You can trade some equities on it. People like it because it has a very active community, meaning that there are a lot of developers, a lot of quants and algo guys who develop automated strategies or custom indicators for this platform, so you don't have to start from scratch. Our focus was to give you a way to do the analysis and trade, and then still test it on the same data that you're using to trade, meaning the data from your broker, as well as incorporate your own position sizing, exit criteria, any of that fun stuff. So as we wait for this to run, once again, we're testing this on out-of-sample data, meaning data that wasn't used to build it. That should finish here in a second. Skip to the end. Here we go, and if anyone has any questions in the meantime. So we can talk about high frequency after. So high frequency on the retail space is a little more difficult. So loading your own data is another request that we get a lot. That's definitely something that we'll be incorporating soon as well. So we want that as an important area. We want to be able to use that analysis for you. So right now, focus primarily on FX and US equities. So if those are two areas that you know, those are things that we can absolutely incorporate. So any other questions as this runs? Going. So we will be sharing the slides and the presentation in the follow-up email. So you'll be able to go through this at your own pace, and we'll also be sharing these this actual strategy so you can trade it yourself. So commodities, another thing that's coming up shortly. You have to excuse us. We're still a startup, so there's not too many of us working on this. So we're really trying to focus on a few areas, which is why your feedback and input is incredibly important. And commodities are another area that we're going to be greatly expanding into. It's something I'm particularly interested in. So it's good to see that I can rely on some of your feedback as well to push that to the top of the list. But commodities and futures are probably our next tool. So how long has this tool been in development? So as a company, we're about 2 years old. Obviously, it hasn't been a straight path to where we are now. It's really only been available to the public in its current form for the last 6 to 9 months or so. So we're still getting started here. For free, how does Innovance make money? So we're looking to white label it directly to brokerages, so you can keep using it for free, and even your broker will provide this for you. So we want to make sure that there's no money coming out of your pocket, that it's always going to be free for you to lose. Tried someone say, had a question that they've struggled with MetaTrader code. That's something that Trade's really good at, is that we can generate the code for you, so you don't need to learn a lot on your own. Obviously, it's always good to have that experience. If you are having any specific questions, I'm happy to help out. So if you want to reach out after, we can do that. Can we use NSE for trades? Not quite sure what that means at another platform. So feature selection is a good question. That's something that we're still working on how to incorporate with Trade. Since so many people, there's so many different techniques, I would recommend learning a couple of the ones that we covered. But since the analysis is done, the back test is done, let's see how well we did. So we can see total net profit if positive, 200 is great, not a huge amount. But what's really interesting is that we can see that we were accurate 66% of the time, but our largest profitable trade was about half as large as our largest loss. Same with our average profitable trade was about half as much as the largest loss. So what we can do now, and one of the advantages, and we can check out the equity curve that seemed like a pretty steep drawdown here in the beginning, is that what we want to do is then add our own risk and money management. Now this is an incredibly important part because you want to be sure that your downside is always protected. So the exit conditions now just mean we get out when the conditions are no longer met, but we can add a take profit and stop loss. So if we just do a simple 100 pip take profit and a 100 pip stop loss, then we should see much better results because we're able to protect that downside risk from us. So let's just run the simulation again with that risk and money management criteria, and we'll continue to answer questions as that runs in the background. So it seems to be an excellent platform for curve fitting. How do you guard against that? So this step right here is really the first of two steps that we use to protect against curve fitting. So when we run the simulation, this is all data that the algorithms and the strategy has never seen before. So if you remember, we only built the strategy up until January 1st, 2015, and now we're testing it from January 1st, 2015 up to today, March 22nd, 2016. Then another area that it guards against is if you notice that these rules tend to be pretty broad, meaning that you're not able to say, okay, the ROC is between negative 1.8 and negative 1.9. That really the smallest range you can set is in increments of these bin sizes. So that really prevents you from over-optimizing and really curve fitting your platform or curve fitting your strategy. So the combination of wide bin selections, testing out of sample, and then we also always emphasize that you run this on a demo account or paper traded before trading live are three crucial steps in preventing overfitting. But it's a great question, Josh, and we always want to make sure that we're conscious of where we may be overfitting. So we're not using the AI, so the question was, we're not using the AI to dynamically adjust indicator parameters as it runs. Is this the real advantage of neural networks or deep learning? So there are a lot of different theories on how to use AI in trading. I tend to place a much higher premium on simplicity and transparency than I do on these much more complex, highly adaptive systems. What I found is that if you do have a neural network or deep learning that's analyzing each and every data point and tuning the parameters as it goes, that really runs the risk of not only overfitting, but you don't actually know when your strategy is going to be trading. You're completely dependent on this, basically a black box, to generate your entry and exit signals. What I like to know is, all right, if these conditions are met, I can be confident that I'm entering in a trade. That makes sense to me. I have the data to back it up. That's something I can put my money behind. Once again, this is my personal preference and what we've had success for. Obviously, a lot of people have built, have had success with these black boxes, But unless you're really ready to commit to building it from the ground up, I think there's a lot of danger in just using a neural network or deep learning without really understanding what it's doing and where it's coming from. So just to reiterate, I like simplicity and understanding, but absolutely these can be used in much more of a automated or black box fashion. So the question is, how do we compare to something like Quant Connect or Quantopian? So we're actually talking to those guys to see if there's a partnership in the works. So their focus is a lot more on automating existing strategies. So they provide that infrastructure and platform where, okay, if you want to code up your strategy, here's a great way to backtest it and trade it live, where our focus is really on that strategy discovery and that analysis process. So you could just as easily, instead of using MetaTrader, use something like Quant Connect or Quantopian to run your strategy. But once again, our focus is on the strategy discovery, and you can see that we're using other tools and other companies that focus on the actual live trading and the automating of strategies. So I like Quantopian and Quant Connect and think they have great products. It's just a different focus from what we're doing. Sure, regularly used email. So this should be included in the follow-up email, but if anyone wants to get in touch with me personally, there's my email address. So how much do you rely on technical data? So for automated strategies, I find a lot of value in technical analysis. If we go back to our platform, you can see that we provide other types of data besides just technical data. So if anyone's familiar with Quandl, you'll recognize some of these data sets. So you can see if you're interested in looking at the price of oil, maybe the VIX, maybe you're interested in price of gold, the euro borrowing rate. Those are all indicators you can incorporate into your strategy. We also have some sentimental indicators based on the US, and this is another area that we'll be expanding. But I like technical indicator strategies. It makes it very easy to trade automated. And I think that it's good to take a holistic view, but you always want to make sure that you understand what you're looking at. So I like technical data. It's a preference. You definitely can explore these other types of data sets as well. So we had a question about what this platform is. So this is MetaTrader 4. So this is a very commonly used trading platform, similar to NinjaTrader, Thinkorswim, any of those. Gallant GCMFX is the broker that we're using. It's Gallant Capital Markets. So really quickly, if we go back to, you can see now with the risk and money management strategy, our drawdown was greatly reduced. We have a much higher absolute final return, and our accuracy is still well above 50%. So that's now the next step that I would do is I would paper trade this strategy for the next 2 or 3 weeks, make sure that the results are holding up, meaning that I'm able to see this 56% accuracy consistent and that returns are positive. And then after 2 or 3 weeks, I would start to trade live. So we went a little bit over time, but just to reincorporate, we're going back to our original focus. I think the big takeaways with this are our original slide on these 4 best practices and common pitfalls. So like I said, you'll get this presentation, so you can follow all the links, dive into yourself. If anyone has any questions, feel free to contact me directly. In the follow-up email, you'll be able to get the strategy that we built, as well as all our information for us. And for those of you familiar with Quantity, I would definitely recommend checking them out. They are great organization, great to really hone your quantitative trading skills. Okay, great. So I can see India's NSE. So we'll be expanding trading platforms very shortly here. So if you want to reach out with any information, that'll be great. So I'm going to continue to stick around answering questions, but I appreciate everybody for coming, and hopefully you found this valuable, and we'll try to get to all your questions, so be patient for me. So which are the most used feature selection techniques for Forex markets and machine learning? Which are frequently used indicators for Forex markets? So feature selection, there isn't really singular best way. It's really going to be, one, what are you trying to achieve? Are you more interested in trading 5-minute charts, 1-minute charts, daily charts, weekly charts? Do you follow the technical analysis camp? Really, for the best feature selection is if you have domain expertise. If you know the markets, if you can say, all right, it looks like if we look at the slope of the RSI as opposed to just the RSI, that makes sense to me. That is the ideal way. And then on top of that, you can apply some other machine learning techniques that we covered to evaluate them. But really, in the perfect scenario, it would be that you do have experience. So it looks like Kill's back on the line. Did you have any final words? Okay, so keep going through these questions. How many indicators? Yeah, go ahead. So I'm just going to keep going through with these questions. How many indicators are used in live strategies, and how much does the strategy complexity increase? There's always going to be a trade-off between complexity, kind of the bias variance trade-off. For my own more heuristic rule of thumbs, I found between 3 to 5 indicators per strategy gives me the right balance of being able to contain a lot of information without overfitting. But once again, it's going to be dependent on your own personal trading style. But as a rule of thumb, 3 to 5 indicators tend to be enough for me. So what are the best machine learning algorithms which actually work in real-world trading strategies? It's less about the underlying algorithm that you're using, and what's much more important is the data or features or indicators you're feeding into it, and then how you're implementing the output. So if you do want to kind of focus on one thing, I would focus on those aspects more than the underlying algorithm. Something like a random forest or a Ripper rule learner or a support vector machine tend to be the popular ones, but it's hard to say this is the best machine learning algorithm. When you look at automated strategies, they tend to follow more ensemble-based technique. So someone's asking if we can use the genetic optimizer in MetaTrader 4 to accomplish the same thing. So the problem with the optimal indicator parameters and compounding them in a final EA is that that's really just going to be, one, it's going to be vastly overfitting, meaning you're just testing every single value over this particular data set. One of the reasons why we use machine learning algorithms like the Ripper rule learner is that they're able to find, at least theoretically, those underlying signals in the noise. The second is that you're only going to be able to optimize for one thing. So meaning, all right, are you just interested in final return? Are you just interested in accuracy? When we're using TRAIDE, we're not only able to try a lot of different indicator combinations quickly, but we're able to see the results, really create that strategy, and look at the equity curve and these other stats that make sense to us. Finally, if you've ever run those optimization settings in MetaTrader, you do know that you'll soon find out that even a very simple, basic optimization procedure can take days to run. So our focus is, let's not just use this brute force methodology, let's use a more sophisticated, intelligent approach. Let's leverage both our own experience and the machine learning algorithms to find the optimal parameters, or at least the parameters that are going to hold up best over live data. Keep looking through these questions. Okay, good question. These indicators are not in MetaTrader 4, something else I apologize for not bringing up. So if you go on to our site, you can find our MetaTrader 4 indicator library that uses, it's a bridge between TA-lib and MetaTrader 4 that allow you to use the exact same indicators that we use in your MetaTrader 4 platform. That's free to use, free to anybody. Go out and check it out. There are instructions on how to load it up. But that's a good point that I should have brought up. Yes, it's important to use the exact same indicators, and we have the indicator library. Some good questions. So it does not have this CBO VIX feed, so you would not be able to execute if you use the VIX. It's a great point. So it's an analysis platform, and if your broker does provide that, then you can use that analysis. So we provide fundamental and macroeconomic indicators on our platform, and then if you want to use that with your broker or when we expand other platforms, you'll be able to use that analysis as well. All right, so it looks like we, does anyone have any last questions? Glad you guys all found this valuable. How good is the combination indicators for day trading? That's something you're going to have to explore yourself. Something that you can go check out on Trade Now or use any of the examples or processes that we went over before. A couple more questions here. Elaborate on using machine learning for value investing. So what you'd want to do for machine learning for value investing is use the same process that we went over, but instead of technical indicators, you would want to use whatever data sets you think are important in quantifying the inherent value of a company. So basically you would say, all right, I think this market cap, or I think the price to earnings ratio is important. Let's see the relationship between that data and the price movement of the underlying asset. And so when you formulate the question in terms of dependent and independent variables, you can use all these same techniques no matter what your underlying thesis is. Yes, so another thing that we're going to be recording very shortly is actually the next release is comparing the in-sample to out-of-sample performance. So thank you, Josh, for bringing that up. I feel like I'm a broken record here, but we're still a small startup, so we're trying to get all these feature requests in as quickly as possible. But actually, the next release will include comparing that in-sample and out-of-sample, just because we see that such a high priority to include that data. Intraday equities trading versus positional trading. Once again, it's going to be up to your own criteria, up to your own experience. What equities are you trading? What positions are you trading? A lot of these are just going to be dependent on what your own criteria is, how you analyze the output. So we just want to give you the flexibility to find the questions to your answers as quickly as possible. Find the signals for increased volatility and large moves. Another good question, Josh. And so basically what you'd look for in that is you'd want to optimize for return per trade as opposed to just the individual returns. So you can do that if you're interested in return per trade, or once we get the capabilities to load your own data, you could load in, try to model the volatility, which a lot of people have had success doing. So the way you can do that today, look at return per trade, but if you're interested in volatility, once you load your own data, you'll be able to do that. So how do you know when your algo is out of sync with the market, stops working? So that's a great question. And I don't know if there's a one singular right answer. What I have found is I look at the maximum drawdown. I look at the probability of getting 5 losing trades in a row or losing 3 of 5, and then I set individual thresholds. So we did a blog article about it. I'll include that in the follow-up as well. But the short answer is it's hard to know, and you're going to have to use your own kind of instincts. I try to take a more quantitative approach by seeing, all right, what was the worst performance I saw in my out-of-sample tests, and once I get close to there, then I cut the chain. I tend to run a pretty tight ship, so meaning once it has a couple losing trades, I'll move it to a paper trading account until I see that it's doing a little bit better. But Gordon, that's a good question about when your algo is falling out of sync, and you just kind of have to use your own heuristics and then experience to figure that out. How hard is it to learn coding in MetaTrader, and it's free? Yes, so MetaTrader 4 is pretty easy. It's a C-based language. So, and if you go to mql4.com, there's a community. It's free to download, and you can use our platform to play around with it as well. It's also free. So using our platform in conjunction with MetaTrader is kind of the best workflow at the moment. And if you have any coding experience, MetaTrader 4 is very easy to learn. Which have better libraries for machine learning, R or Python? That's a good question, and there's probably going to be a lot of different answers. depending on who you ask. The short answer is they both have great libraries for machine learning. R is going to be better for out of the box. So meaning, all right, I just want to use a support vector machine and run it. Python's going to be better if you want to really dive into the code and optimize it yourself. So depending on your own experience and background and understanding of coding, that's going to really defend your decision. So if you're looking for a more plug-and-play option, R is great for machine learning. If you're looking to build it yourself or get your hands dirty, Python's the way to go.
Well, algorithmic trading requires you to merge two traditionally disjoint set of skills. One is finance, another is technology. So you need to merge skills in finance and technology to be able to do algorithmic trading. So you need to understand the markets, you need to understand big data statistics to be able to design your strategies. But once you have designed the strategies, you need to also understand technology to be able to automate your strategies. So therefore, that is where the Quantities education programs come into place. So we train people about the entire gamut of operations and skills required to be able to be a successful algorithmic trader.